So here we're going to talk about different ways that we can different methods that we can use to calculate our bad debt, to calculate that uncollectible account, okay? The first one is what we call percentage of receivables method, right? This estimates your uncollectible accounts based on the percentage of accounts receivable that you expect not to collect, okay? So if you have $30,000, it's what we did in the examples previously, right? You got $30,000 worth of AR, you expect not to collect 5% of that, then your bad debt expense is going to be $1,500 and your ending balance and allowance will be $1,500, okay? So you are going to estimate this based on a lot of different things, right? Current economic conditions, historical data from the company, historical experience that you have, industry guidelines, benchmarking against other competitors in your industry, okay? The other method that we've got is what we call aging method. And this is where you're going to base the estimate of the bad debt based on the age of individual accounts receivable, okay? The important thing here to note is that you're going to use a higher percentage for older accounts than you will for new accounts. So basically, the older the account is, the more likely it is that you will not collect on it, okay? So this is where you'll have what we call like an ATB, an aged trial balance, right? So you'll have all of your accounts that are 0 to 30 days old in one bucket, and maybe that's a 2% uncollectible rate. And then you've got 31 to 60 days in the next bucket, and maybe that's a 15% uncollectible rate. And then once you finally get to 365 plus, that's 100% uncollectible rate. So just the older the account is, the less likely you are to actually collect on it. Okay, so either method that you use, your journal entry is going to be the same. Okay, it's going to be identical. So let's take a look at an aging schedule here. This is what I call an aged trial balance, right? And we're going to look at this and say, okay, we've got some that are not due yet, and we think that anything that ends up in our not due bucket is 10% chance we won't collect it. Okay, then we have 1 to 60. 30% chance we won't collect that. 61 to 120, there's a 50% chance we won't collect that. Anything more than 120 days old, we believe there's a 70% chance we will not collect it. You sum those together, and that gives you your estimate for your bad debt, okay? So, if the estimated amount of uncollectible is $7 million, then the allowance for uncollectible account needs to have an ending balance of $7 million, okay? So the estimate that you make based on your AR becomes your new ending balance for your allowance account, okay? So you need to know the current balance of your allowance for uncollectible account. So a positive or credit balance means that maybe you overestimated the amount of bad debt that you were going to have. Your estimate for the previous year was too high. So let's determine the adjustment that we need so that the ending balance will be $7 million. So basically this is, if I have $5 million, a $5 million credit balance in my allowance account, I only need to add X amount of dollars to get it to $7 million. In that case, it would be $2 million. So our adjustment would be $2 million, okay? So you're going to increase or decrease the allowance for uncollectible accounts by that needed adjustment amount. So let's say that Kinsey had a beginning balance in 2025 of $6 million. They wrote off $4 million throughout the year in 2025. So their current balance before the adjustment is $2 million. They know that they're estimating that they'll have $7 million in write-offs. So what do they need to do? Well, it's 2 plus X equals 7, X equals 5, right? So they're going to need to add $5 million as an adjustment. That adjustment is also the bad debt expense. So they will have a bad debt expense this year of $5 million, okay? The journal entry looks like this, okay? Bad debt expense, $5 million, right? We're recognizing that expense. Then we're going to increase our allowance for uncollectible accounts by $5 million. This is an increase. It's an increase in the allowance account. We're estimating future bad debts, okay? So this is what your balance sheet would look like. We have AR of $30 million less the allowance for uncollectible accounts of $7 million, giving us net AR of $23 million. Okay, so that is how we're going to calculate the allowance method, or calculate our allowance for uncollectible accounts. That's using the allowance method. Remember, we do not use the direct write-off method in accrual accounting. So just as a couple reminders for you guys to write down and know for your exam, first thing, Your allowance for uncollectible accounts is a contra asset account. It has a debit or a credit normal balance in it. Okay? The estimate that you make at the end of the year based on your ending balance of accounts receivable becomes the new ending balance of your allowance account. Okay? The adjustment that you make to your allowance account to get it to that ending balance is your adjustment and your bad debt expense. Okay? Remember, you only use the bad debt expense once during the year, and it is when you make that adjustment to your allowance for bad debt accounts. So next video, we'll talk about revenue variances, and that will be it for Chapter 10.